Chairman and Managing Director, Mrs. Darshana Pandya, Director and CEO, Mr. Ankit Jain, CFO, and also we have a senior management team of the Mass Financial. We will start with the opening remarks and then open the floor for Q&A. I thank the management for giving us the opportunity to host the call. I will now hand over the call to Mr. Kamlesh Bhai for opening remarks. Over to you, sir.
Thank you, Ravish, and good evening to all of you. And first of all, I wish all of you a very safe health, and I wish all of you are in good health too. So as we all know that we have been passing through a very turbulent and challenging time, but as always and inconsistent to our policy, we'll be focusing more on the possibilities than the problems. So we would like to magnify that. So what we have been doing at Mass since inception and more precisely from last year is to strengthen the balance sheet size without being much bothered about the comparative figures on growth and profitability, while we have done well on that front also. So just to take you through the fundamentals of the company with a 27% of capital adequacy and a liquidity buffer of more than 1,000 crores and a provision which we are not dipped into. We have kept the provision constant at 56 crores, and after that having a net stage 3 asset at around 1.53%, and ending with a yearly profitability of 143 crores is what we have done over this year. In terms of the quarterly performance, the profit stands at around 36 crores, 34.5 crores for 36 crores for the quarter, which is a slight jump over the last corresponding quarter of around which was around 34.5 crores. And in terms of disbursement, this last quarter, that is the quarter from January to March, we all were happy to see that the economy is coming back to normal, and that was reflected in our working also, where we could register a disbursement of close to 1,300 crores as compared to 1,000 crores the previous quarter, that is the quarter ending December. In terms of the various assets under management and in terms of the various products what we have been dealing into, it has been around close to 3,000 crores in micro enterprise loan. SME loan contributed 1872 crores, two-wheeler contributed 326, and commercial vehicle contributed around 202 crores. And overall, there was a dip of around close to 9.95% in the total AUM. But as I shared with you in the beginning, that was not the area of focus. The area of focus was to strengthen the balance sheet, because being a practitioner for more than 25 years, we firmly believe that this shall also pass, and when the economy returns to normal, the companies with the strong fundamentals will again have an opportunity to grow their balance sheet size. And so are we also confident that once things come back to normal, we will come back to a trajectory of around 20-25% growth. And we have a very strong enablers for the same, whereby the capital adequacy is more than sufficient. We have grown mainly through internal accruals because of a very strong track record of the debt management. We are very confident to raise the debt at competitive rates. And last but not the least, the vast market size which we serve, that is MSME, and our niche expertise. So this is how we have navigated through this crisis, and over the last 25 years, we have focused mainly on creating quality assets, whereas I personally believe that every one of us are mandated to create quality rather than just the quantity. In terms of just to apprise you on our housing finance numbers, the housing finance AUM stood stable at around 284 crores, and we could register a high profitability in housing finance due to lesser provisioning this year. Anyhow, we carry a provisioning of 1.25% of our own book assets even in housing finance, with net NPA around 0.26%, which is once again stable as compared to the last year. We have been at a stable AUM since many quarters in housing, and we internally believe that we had valid reasons to be there because of the latest development in the market, and then since last 12 to 15 months due to COVID. But nevertheless, let me assure you that this is going to contribute very meaningfully over the next 3 to 5 years, because the way we have established ourselves in terms of systems, operations, in terms of managing the quality of the assets, and here also the capital adequacy is very strong, with a very strong commitment of capital as and when required by the parent company and the promoters. So while it has been a stable AUM since quarters, we are very confident that this will contribute very meaningfully in coming 3 to 5 years. So this has been why we had a very detailed presentation and also a very detailed press note. I will not take much time on the commentary so as to give you more opportunity for your queries. I will request Ankit if he wants to share something on the liability side. And before that, I think I missed out on one or 2 points which I'd like to share with you, which you all must be interested is on the collection efficiency. As shared in the presentation, we had around 95% collection efficiency in the last quarter. April it has dipped slightly to 92, and we are yet to see what exactly the figures will be in May, given a massive disruption in the economy. So we'll be in a position to know that how it pans out within a week or so. But looks like it may dip further, and that is very for the obvious reasons. On the restructuring part, as I had communicated in last time also that it will be less than 1%. It's around 0.3% as on 31st March. We had been very cautious in restructuring only to those who can repay, and for them the credit history is not distorted so as to enable them to raise money back from the other financial institutions. For them we have granted restructuring. So it has been around close to 0.3% on restructuring as on 31st March. Now I'll hand it over to Ankit for his brief on liability.
Yes, thank you, sir. Hello all. To further elaborate on the liability management, company during the quarter through its efficient liability management was able to maintain liquidity buffer of around 1,000 crore and unutilized cash flow facility of around 325 crore. In addition to that, the company has sanction on hand to the tune of 1,000 crore in the form of term loan and direct assignment. In the last quarter, company did around 190 crore direct assignment transaction. The company further has more than 800 crore sanction on hand, which will be utilized during the current year. The company has available cash flow facility of 1,795 crore, out of which company maintains utilization of level of 65% to 70%, and this portion is kept as a liquidity buffer. During the quarter, we successfully rolled over around rupees 1,100 crore short-term working capital loans, which are sub-limit to the cash flow limit. Company raised around 655 crore term loan during the quarter. This helped us to further strengthen the asset liability maturity pattern. The company further has around 150 crore sanction on hand, which we will utilize during the current quarter. Just to add on, the company raised rupees 200 crore refinance from NABARD during the quarter. This was the first relationship with NABARD, and we both to take it a new height going forward. Company also raised first MLD, which is market linked debenture for 55 crore during the quarter. So it was a 50 plus greens to option of 15 crore. On the ALM, company has also assessed its structural liquidity for the period ended 31st March 2021, and based on the assessment, there is no negative impact on the liquidity, and the cash flow in all the cumulative buckets remain positive. The company capital adequacy remains strong at 26.85% with Tier 1 of 24.81%, resulting into a debt equity of 3.12 times. Just to highlight, the cost of borrowing for the quarter works out to be 8.75%, which was for the December quarter 9.10%, and for the whole year it was 9.10% compared to last year, which was 9.32%. So by the efforts, efficient liability management, and because of a reduction in MCLR by the banks, we are able to reduce our cost of borrowing, and we further aim to reduce it further in the coming year, during the current year. Thanks and I hand over the call to Kamlesh.
So thank you, Ankit. And that's all from our side. And now we are open for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Malhar Himal Manek from Manek Investments. Please go ahead.
Good evening, sir. Hope all is well and hope you are not impacted by the cyclone. Sir, my first question is about Samban Finzers. I am aware that we have provided for our total exposure of 18.4 crores in the second quarter itself. But I want to understand why exactly this happened, because in the letter written by the CFO, they mentioned that they were cooking the books all the way since FY16. And another Ernst & Young report mentioned that the fraud has been going on for 8 years. So I want to understand why were we unable to spot it? Like, is there any flaw or inadequacy in our due diligence process? And what changes have we made to our due diligence systems to make it more stringent? And what is the likelihood of such an event occurring again in the future?
Thank you. We are good. The cyclone has not affected as it was anticipated. And Mala, this was discussed at length and been shared in our investor presentation many times. So would not like to repeat it again. But once again, this is a one-odd incident in our 14,000 crores of a cumulative disbursement, which and overall our NBFC portfolio is managed in such a manner that our net loss is less than 0.5%. And this has been explained in our presentation and in the last con call also sufficiently enough to how we just strengthened. And I would request you once again to go through our presentation where there are around 4 to 5 slides dedicated on how exactly we are strengthening. And strengthening the systems and operation is a part of the credit process. And we should understand that we are not in the business of avoiding risk but managing risk. Such type of incident can happen, may happen, but it is only about how you take it, what is the capacity of the company to absorb it, and what is the capacity of the company to learn and unlearn from time to time.
Okay, got it. And sir, my second question is that Daksha ma'am is an independent director on our board as well as the managing director of another NBFC, Altura Financial Services. And in October of 2019, Altura had sold its microfinance portfolio to Centrum Microcredit. So it seems like Daksha ma'am may be an interested party in Centrum Microcredit. And if I am not wrong, as at June 2020, we had given a term loan of 94.96 crore rupees to Centrum Microcredit. So can you please clarify the reason for this?
I'll ask my company secretary to ask to give you the reply on the conflict of interest of Daksha. It is not so. So there is a timing whereby she has already resigned as MD from Altura, and then she was appointed as a board member. But my company secretary will answer at length on this conflict of interest, whatever you are telling us.
Okay. And sir, just one quick question. In our NCD by private placement at 9% interest on 16th June 2020, I know that we had PSU banks like Central Bank and Union Bank that had invested. But which were the private sector banks that invested?
So, Mala, this was the NCD which was issued under the PCG or the guaranteed by the government. And that was only allowed for PSU banks.
Okay. So there were no private sector banks in that?
It was not allowed by the government.
Okay, got it. And sir, lastly, I have some suggestions for improving the due diligence process. So can I please
So
contact you?
this is not the right forum for suggestion. Suggestion can be mailed, and I receive your mail from time to time. So let it be limited to the financials and the queries that on, because suggestions is an endless process. I am happy to see you so inquisitive at your age, but and I receive your mail very regularly. So let us keep suggestions not on these forums.
Sure, sir. Got it. Thank you, sir.
Thank you. The next question is from the line of Sarvesh Gupta from Maximo Capital. Please go ahead.
So just one small query. This March quarter was supposed to be, many financial firms have been able to land up at a gross NPA number which was similar to without dispensation figures of Q3, because March was a very strong quarter of business. But for us, there was some spike. So this plus, the trends that are you seeing in the last 1.5 months, if you would want to give some color on our overall gross NPA numbers, as well as I think this time even for our assigned book we have disclosed some numbers of gross NPAs, etc. So if you can throw some light on that as well. That is number one. Secondly is a bookkeeping question. I think the difference in the net worth for the full year between FY20 and 21 was much larger than the PAT net of dividends. So if you can just explain the difference.
Coming on the quality of the portfolio, we always maintain that it will be range bound. So if you recollect, we always told that our GNPA will remain between 1.5 to 2%, and we have ended up at around 1.93%, especially taking into account the class of the customers who will be served to. And secondly, after closing and all, it is at around 1.53%. So while efforts are continuously on for better credit due diligence and collection, but this is in line of our expectations for the year. And going forward, looking at the current scenario, it will be difficult for me to predict as of now. So once the things open after, say, 8 to 10 days in phases at various places, we will be in a position to assess what exactly the situation is. We all know that this wave is different from the last wave. This wave has hurt more of the human resources also, rather than just the businesses. So the capabilities to connect to them is also reduced since a month, and that we are trying to reconnect to various stakeholders, especially the borrowers whom we are serving to. But within next 15 days to 1 month, the things will unfold. But I personally believe, looking at our due diligence and the past experience, that the provisions what we have and the way we do the credit due diligence, once again GNP will be range bound around 2%, maybe spike in 0.25 to 0.5% temporarily, but can come back to normal, and LGDs will remain within the expected lines, because NPA necessarily does not mean loss given default. It in our cases where we serve to the informal economy, the chances of collections are very high. On the Ankit can answer that the difference in the net worth is due to OCI, right?
Yeah. So what happened is because of the index impact, the OCI is the provision which we do is added in the OCI, and therefore the numbers of will not match from the PAT directly.
Understood, sir. Thank you, and all the best for the coming quarters.
Thank you.
Thank you. The next question is from the line of Bhavesh Kanani from ASK Investments. Please go ahead.
Thank you for the opportunity, gentlemen. My question is really on the provisions and how they connect with the asset quality existing as well as anticipated trends in the 6 months going forward. So as you mentioned, our restructured pipeline is not that heavy, but given the second wave, and as you mentioned, the second wave appears to be a little different in terms of impact. How high can this restructured pool can go to? and overall behavior of collection, as you mentioned, in April there has been a dip. So putting all these things together, your view for next 6 months, the dip in provisions during this quarter was a little surprising. Are we, in conclusion, seeing that the buffer provision we have for COVID as of now is sufficient to tide over the challenges that we may experience in next 6 months? Or we can resume higher provisioning rate in the coming quarters?
So starting from the COVID provisioning, as I shared in the opening remarks, we have not dipped into it at all. So we have kept it constant, presuming that the COVID provisions, the COVID condition is prevailing. Now, as we know that every time a new wave comes, we see a different dynamic and dimension of the impact. Now, the dimension and the dynamics of this impact will take around a month, as I shared earlier. It will take around a month or so for us to really assess. But as of now, as I talk to you, 1.39% on-book assets of provisioning on stage 3 assets, it covers our stage 3 on-book assets completely. And it covers around more than 60 to 65% of our stage 2, stage 3 assets. So we have reasons to believe that the current provisions are sufficient. But if the situations are still unpredictable and dynamic, what we can do is that we can keep this provision stable and then create a new one also, or write off progressively, keeping this provision stable. Coming to the provisions for the provision figure which is reduced. Now what has happened is that we are covered under ECL, that is expected credit loss, which is based on the past performance. Now basis the past performance and basis the write-off what the company has taken, this was the number what we have arrived to in terms of credit impairment for the quarter. And even though we had we have endeavored with the auditors to have the maximum management overlay, otherwise what has happened that what we had predicted at the time of COVID for COVID provisioning, as such we had performed far more better than that. But we used our management overlay to keep the COVID provisioning constant and then had to apply ECL to arrive at the provisioning figures.
Okay. And sir, you just touched upon the housing finance business a bit, and you sounded quite positive on the 3-year, 5-year horizon. Can you add more color to that business in terms of what your plans are, how the experience has been during this COVID? The basic numbers you have shared are quite interesting and impressive, but if you can add more color on your view for the next 3-5 years.
Yeah. See, we basically serve to the rural and in the affordable space. And I've shared this right from 2017 onwards, and then we know that we have been facing a lot of challenges where we decided to focus on the fundamentals rather than growth. The basic model is to touch first the rural villages in Gujarat. Gujarat has 17,700 villages, and out of that, even though we can have around 500 to 1,000 villages with a crore of a portfolio outstanding, can give us a very good AUM from the rural places itself. Having said that, this is a task to be worked upon. It is not as simple as putting it on the Excel sheet. You need a team, you need the processes, you need all the enablers to convert this potentiality into real business. But we are very optimistic to do it, maybe quarter here or there. In the affordable space, what has happened is that when we started affordable housing, there was a lot of problem on the supply side. Now, supply has eased a lot with many of the developers moving towards affordable housing, seeing more opportunity in affordable housing as compared to the high-cost housing segment. So the supply has improved. And secondly, since the supply has improved and the demand has not picked up so much, the developers are also showing rationality in their pricing. And secondly, there has also been a tremendous attraction from the interest rate point of view formally what as a HFC of our size would have offered at a rate of anywhere between 13 to 15%. Now is the same loans are available between 10 to 11% even to the informal and even to the low income group. So the combination of the demand, the combination of the supply and all these factors, including the availability of funds and the rationality in the prices, should contribute to translating this potentiality into business and into the AUM we want over the next 3 to 5 years. So this is what makes us very confident of that.
Any broad numbers you would like to share, or the guidance that we give for AUM growth over long term 20-25%? That includes the housing piece, or that is in addition?
That is more on our, when I talk about 20-25% is more on the standalone. Housing ideally at this stage should grow at 30-35% plus.
Okay. Thanks a lot for answers, sir.
Thank you.
Thank you. The next question is from the line of Shrishtik Datta from SMS India Private Limited. Please go ahead.
Hello. Am I audible?
Yes, sir, please go ahead. We can hear you, yes. Please go ahead.
Yes. Sir, I am a retail investor. So as you understand that being a retail investor, my interest is more on the part of how the share value is moving, and also how your internal business is moving. So I just, as a retail investor, ask you, as the management of the company, how do you see the growth of the company in the next 1 year?
See, if you ask me, we always have a medium to long-term view, because if you have a very short-term view, you have short-term actions. So over the years, if you see history of Max in our investor presentation, we have shown, if I step in your shoes as a retail investor, what am I going to look into? That if you see the history of Max starting from a 2 crore asset size in 1995, it has registered a CAGR of 35% plus, be it the AUM or be it the profitability. And 25 years is a very long period to judge a company through all thick and thin. Over a year, very difficult to predict right now with the second wave, but the fundamentals of the company is to grow anywhere between 20 to 25%. Once the economy normalizes, we see no reason why we should not grow at that rate, with all the enablers of a very strong capital, very strong capabilities to raise debt, and a very large market size whom we serve. As far as the prices are concerned, I have no control on that. It is only about how we perform, and we all know that investing is a business where you need to be patient, and once you are patient, and the companies like us who are generating a CAGR of 20-25% over a time horizon, you will definitely get good returns.
Okay, thank you.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hello, sir. Good evening, and thank you for giving me the opportunity. Sir, I just have a few questions. Firstly, sir, if we look at the disbursement number, we've seen 25% quarter-on-quarter growth, of course, because of the low base. But if you look at on the loan book side, the SME book has grown by 22% sequentially. So fair to assume that most of the disbursement was towards this segment?
Yeah, because we serve MSE, SME, two-wheeler and commercial vehicles, and this was the area where we found good opportunity in the lines of our dictum of extending credit where it is due, and because of our distribution model of working at 3,500 places, along with the NBFCs whom we are connected with, there are more than 100 in numbers. So that was a good opportunity this quarter to fund to them.
And sir, anything that we have done on the ECLGS side for any of our customer segments, like across the product category that we cater to?
Yeah, ECLGS. Yeah, so far we have disbursed 19 crores under ECLGS.
For the whole year, is it, or only for the 4Q?
For the whole year.
Okay. Okay.
The disbursement was started from the second half only.
Right. Okay. And sir, the next question was with respect to our. I mean, if you look at our say 1 to 30 DPD and the different buckets, what would be the 31 to 60 DPD for each of the segments? If you can give some color there, like which segment would be having higher proportion of the 31 to 60 and 61 to 90 and above 90 DPD sort of. So if you can just give some color on the product segment there.
In that, we are seeing stress on the two-wheeler portfolio followed by commercial vehicle and then MSME and SME in order.
Also, commercial vehicle.
Okay. Though overall it is 1.22%.
Right. Yeah. Overall, the numbers like I have it, but I was just thinking as sir indicated that the higher stress is like.
So that is what I shared with you. That is start with two-wheeler, SRTO, MSME and SME in that order.
Okay. And so have we not because restructuring as a regulatory support is available. So do you think we will be using that as a tool in the coming quarters? Because you're seeing the second wave impacting us or at system at large, everyone. So you think we will be using that tool in the coming quarters?
See, we are more than happy to use this tool for the ones who really deserve. I shared in my last commentary also that restructuring will depend upon the capabilities of the borrowers to pay once it is restructured. If we think that even after restructuring the cash flows are not sufficient to pay, then it makes no sense to restructure. So we see at the merit of each case the cash flow, the new cash flow post this COVID and all. And when we see that this case is deserving, then only it is restructured. Otherwise, we take it as the bucket it comes. So at the end of the day, we are not getting any unknown stress of the portfolio in the balance sheet.
Right, sir. That, prudent call actually. So one last question. What would be the collection efficiency? I understand that you've given that number at 95%, but within the segment, if you look at, I understand that you said that, in two-wheeler, the stress is high. But what would that number look like for the month of Feb, March, and sort of April? For each of the segments.
When we talk about slippages high in two-wheeler, it implies that the collection efficiency was low there. So once again, the collection efficiency challenges following the priority of two-wheeler, SRTO, MSE and SME.
Okay. And so one last question was that we raised 200 crore through NABARD. Is that number right or I have got it wrong?
Yeah, 200 crore.
Yes, 200
yeah.
crore.
And what was the rate of, what rate were we able to raise that?
So that will be all in 9%, whereby the loan is for 5 years.
Okay, long term for 9%. Okay.
Yeah.
Thank you so much, sir, and good luck for the next quarter.
Thank you. The next question is from the line of Rahul Maheshwari from Ambit Asset Management. Please go ahead.
Am I audible?
Yeah.
Yeah. First of all, good evening, sir, and hope all well at your end. Sir, I had two questions. Going last 1 year, the management and every company has gone through sailed through the headwind. What are the key learnings or in terms of your underwriting or what credit tightening which you have done, or in terms of the employee productivity? Any three pointers or hard practices you would be following in FY22? It would be very helpful in terms of to know how stringent you are making your credit practices also.
See, as far as the credit dictum is concerned, of extending credit where it is due, based on their liquidity, solvency, business model, past track record are the fundamentals which are always followed during good times and during challenging times. Now, have you changed your assessment technique is very important, and that assessment technique changing is a continuous process. Say, for example, right now, the data cycle will be delayed for certain businesses or some other implications of delay in their order book, or they're not getting the liquidity sufficiently they would like to raise from the other sources. All those counts are taken into account, and then the credit assessment is done, and with a higher haircut or with a higher conservative approach. And that is being revisited every month now, depending upon the product, depending upon the branch, depending upon the behavior of the portfolio, and it is very dynamic in nature. In terms of employee productivity, as you told, this was the time whereby we need to stand by them, and we had utilized this time to engage with them more closely on the future path of the company, to motivate them to identify their career and their working with the company's ideology and company's goals, and interacting with them and getting the feedback from them from time to time as to how we can be more relevant at the marketplace while not compromising on the asset quality has been our prime objective during this period where we had less action on the ground.
So, sir, in terms of, as you told, it's an ongoing process, and definitely I agree with you, sir. But in terms of as India's business economic activity is down, so what is the company's rejection rate? If you can give in terms of range, that in Q4, Jan till April, how the rejection rate has been going through, because you have to tighten the screw when the things are not good. So that would be very helpful, sir, in terms of understanding your more tightening of credit norms.
So the rejection rate in the last quarter can be would be around 40 to 45%, as against our normal rejection rate of around 20 to 25%. So almost increased by 1.5 to 1.75 times.
And in April and May, it has further increased, sir, or it's at 40-45% only?
April and May, we are struggling to get the logins, because in majority of the area, people are not interested in taking loans. They are interested in taking remdesivir and other drugs. Loans के लिए कोई नहीं आता है अभी.
Right.
The disbursement in April and May has been hardly 20-25% of what we used to do. And to be honest, we are also not focused on that, because the welfare of the employee, starting from the welfare of the family to employee to relatives, had taken the precedence over everything.
Sure, sir. 100%, sir. 100%.
Yes.
And sir, second, last question from my side, sir. As you told that MAS in last 1.5 years at different times of calls or different points of meetings, that MAS is evaluating on the co-lending or co-originating platform, or having the tie-ups with the fintechs. Sir, if at all you can give some highlight that how the proceedings are going, or what you are evaluating, want to transform yourself into. Though exact details about with whom is not required, but how the transformation will be taking place, that's more important. What you are looking for.
My thought on fintech is the ones who are tech has to learn fin, and ones who are only in fin have to learn tech. And that is where fintech will really work. So we are more on the fin side, being the conventional lender for so many years. We are tied up with so many fintech for origination, for co-lending, and we are working on various pilots whereby our contribution is on credit prudence and extending credit where it is due, and their expertise comes on scale and speed. So right. we are very continuously engaging with all of them, and it's a work in progress still. Before we can zero down on this is the number what we are going to take, or this is the target what we are going to achieve. So it is not on a target basis right now. It is more on the basis of understanding each other and having a common ground whereby we can scale up, we can be customers' delight by using technology, but at the same time, we don't end up with higher losses, because at the end of the day, if we end up with higher losses and don't make money, all these things will not make sense. So on this fundamental, we have been tying up with almost all of them, depending upon the merit, depending upon the product they are into. But we are very sure that the tech part will play an important role, and we are working very actively and consciously on that.
Sir, just a follow up on this question. If you are having a tie-up with, if you are evaluating such kind of tie-up, so can we assume that leaving apart the 4 segments where the company is, it can enter into a fifth pillar of a consumer-based lending in terms of unsecured, or it would be related to the existing segments only?
And it will be limited to the existing segment, plus we'll be trying out some sort of personal loans as a pilot.
Thank you. I would request Ms. Maheshwari to rejoin the queue for follow-up questions. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks, sir, and I think it's pretty commendable the way the company has cleared itself during these challenging times, and hope it continues next year as well. So, if you can talk about the how has been the feedback from your microfinance customers, and for the past month or so, and how do you think that they are responding to this challenging time, especially the past 1.5 months has been pretty challenging, and any views how their collection efficiency is shaping up, and what are your expectations about this portfolio performance?
On the feedback on the microfinance side, till April and everything was up to normal, so to say. And from May, as I shared with you, it is not a time to take the exact feedback from them regularly. But we have seen that this time the rural folks have also been affected. So this will definitely have the impact on the collections of the microfinance NBFCs. But having said that, the ones whom we work with an arrangement whereby they take the complete guarantee of what we fund through them, and we work with those who have sufficient solvency and liquidity, so that they can absorb that. But stepping in the shoes of MFIs, their collection efficiency, which has stabilized in the range of around between 85 to 95% for various NBFCs in various areas, will again see a drop. How much drop? Difficult to tell right now. So that sector once again will have to cope up. But the positive part is that the once thing normalizes, this is the one which recoups the fastest, because they are into all basic activities. The loan size is less, the installment is less, the requirement of continuous credit is there. They don't need to, they would not like to spoil their credit history. So these are the strong enablers for those guys to recoup fast. That is what we are seeing in the first wave, that the collection efficiency was increasing pretty fast as compared to other sectors.
Sure. So, are we currently, providing support to this our NBFC customers and extending credit to them, or we are also being a bit more cautious and evaluating on a case-to-case basis, or we have stopped disbursement to them for some time and see how the overall situation pans out in the next year?
It's not about stopping disbursement in April and May, but just to share with you, there has been hardly any demand because further disbursements are not there. And wherever there are demand, we get into it very thoroughly as to what are the opportunities for those people to create the portfolio the way we want and in the manner we want. So that has been evaluated very closely, and while evaluating this and the basis of the demand, we have found hardly any opportunity during this month.
Okay. Thank you so much, sir. And wish you all the best.
Thank you.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah. Hi, Kamlesh. My apologies, but I joined the call fairly late. So in case if a question is repeated, please pardon me.
It's absolutely okay. Yeah.
Yeah. My first question was on the expenses, both staff expense and the other expenditure. So staff expense I'm seeing is virtually at about 7 crores for last 4 quarters. And it was about close to 13 crores in the March 2020. Are we not keeping this too tight where on a long run it can affect our operations? Because if the staff expense is so curtailed, will it not affect the long-term performance of our business?
No, just to share with you which the majority of the sacrifice has been done by the management team in terms of foregoing salaries or taking a salary cut, because I believe charity should begin from home. So as far as the major impact is on that account, plus we have a structure of fixed plus variable. So obviously when the business is down, the variable cost will also come down. And in the terms of fixed cost also, we are thankful to the complete team who are very voluntarily. We have not imposed that. Until March, had taken deductions varying from 25% to 5 to 10% depending upon their scale. And we had just stabilized or restored that amount in March. And again, we are seeing this. And in April and May, we have stick our neck out and we have not gone for any such adjustment. So it's a combination of the management team sacrificing and also the complete the complete team at Mars responding to the call of taking the curtailment in their fixed salaries and variable cost, obviously, as you know, because of the low business has reduced. But let me assure you, this is not at the cost of sacrificing any of the talent which we want. Let me tell you that in last, not only 1 year, in the last 3 years, or maybe more than that, but I can tell within last 3 years, we have hardly lost any of the senior guys who really matters.
My purpose was merely to check that in order to improve our short-term performance, it should not happen that we take a long-term.
No, I absolutely understand and I agree that, and as you know, Bharatji, we never have a short-term view because we have been reporting on quarter post listing. Otherwise, we always take a longer-term view, and a medium-term view for me is 10 years. So we never take a short-term view, and it was a well-informed decision taken as a team.
And I suppose with sufficient part of their heart in agreement on that.
Yeah, absolutely.
The other question was on the OPEX. There surprisingly, I'm seeing a huge degree of variability. 10 crore in March 20 to 3.6 in the first quarter, then 5, then 8, and now 13. So any reason why these expenses are behaving in an unpredictable way?
We are talking about other expenses, right?
Yeah. So last 5 quarters starting from March 20, 10 crores, 3.5, 5, 8, and 13.
In other expenses, the sheet I am having, I'm not getting that number right now. But if I tell you the other expense portion on a sequential basis this year includes our 5 crores, close to 4 crores of unspent CSR. Formally, the CSR was to be charged against P&L on when you spend it. So we already have projects identified on education and health, and that project takes time to absorb the money the way we want to distribute from time to time. So by the recent guidelines for this quarter, we had to account for around 4 crores as CSR as other expense.
That is occurred in the March quarter.
Yeah, that is only in one quarter. So if you say on 31/12/20, the other expense is 6.04 crores, whereas in 31/3/21 it is 11.74 crores. So you from 11.74 crores, if you deduct 4 crores, it will be close to 7.5, which is under the normal business pattern.
Okay. The third aspect was on the asset quality. And I know that in general you have been very, very careful and very strongly focused on ensuring quality of the asset in a tight band. But I was a bit surprised at the credit cost which is being charged in the fourth quarter. If you see the gross NPA, that has moved from 67 crores in the third quarter end to 104 crores. Our net NPAs have moved up from 51 to 82. So provision cover has more or less remained around 21-22%. But gross NPAs have moved up, net NPAs have moved up, but the provision credit cost that we have reflected in the fourth quarter has been relatively modest at only 7.5 crore. So I hope, to your mind, it reflects the full reality and all that you need to charge and account for has been taken into account.
So it is to start with understanding the number. The 104.30 out of 104.35, there is a 40 crores of element which is assigned. So we are not supposed to provide anything on that. And this 40 crores is because is a cumulative figure over all these years. Because since it is assigned, neither can I know whether banks have written off or what they have done. So we keep that figure as it is for more transparency of numbers. So out of that 40 crores is that portion, and 64.42 is what belongs to us. And this 40 crores, just for the sake of information, is over a cumulative assignment of more than 10,000 crores over last 7 to 8 years. So this is the first thing which I like to bring to your notice. And secondly, I think I discussed this with Bhavishvi also. That secondly, if you have noticed, we have not dipped into our COVID provision at all. We have kept it status quo at 56 crores, despite of the fact that we have gone through a full year of a COVID impact. And that we have used it as a management overlay. Now what happens under Ind AS, we are supposed to provide as per the ECL, expected credit losses in the future. So basis the ECL, this credit impairment is taken and the complete management overlay. It was on me or it was on the management to dip into the COVID provisioning, because the portfolios behaved far more in a better way than what we had projected while creating the management overlay. So we used that management overlay and kept it as it is, and the ECL was used to arrive at the credit impairment.
Sure. No, I fully appreciate. I know the conservative standards with which MAS operates. I just wanted to be sure that. So essentially, what you are saying is that whatever credit cost you could see and you believe is likely to be there is taken care of into the books, and you are sitting on a healthy additional kind of a buffer of almost 60 crores for any potential contingent.
Exactly. Right.
But one last question on this, right? This I have asked you before also, and last year has been a very, very unusual and difficult period. Just when we thought that probably we are going to see this back of this monster, once again, it has created uncertainty. But is it likely or has it happened that we have become a bit more defensive than we should be. While clearly prudence Mark is always represented due desire and aspiration for superior growth. At the same time, very careful assessment and tight credit quality, which is the way lending business has to be. But I'm saying, are we a little bit getting a bit too conservative and shrinking within ourselves, or it is just that whatever has happened and is happening, and in your opinion, the way we are playing it a bit more conservatively is actually the best way to do?
So we have kept it very simple over all these years at Mark. That quality, profitability, and the growth. And with the market and the strong enablers what we have, we strongly believe that we have all potentiality under normal circumstances to grow between 20 to 25%. If I just give an example, in Q3 we had disbursed 1,000 crores, but Q4 was normal, we could disburse 1,300 crores. Q3 was 5,020 in AUM, and in Q3 it is 5,300 crores. So indicative of the fact that whenever we get opportunity, we are keen to grow. Because as an organization which is not keen to grow, practically it will be difficult for them to survive. But as a practitioner, I think that there's nothing wrong to be over defensive for a particular quarter or two. Because unless you gauge the complete things as to how the things are panning out, and just going for a high growth can be counterproductive at times. But having said that, we are inclined for a quality growth. We have demonstrated that whenever we get an opportunity, we will do it. We are very confident a quarter here or there, or a 6 months here or there, Mark will double its AUM every 3 to 4 years. If you see, when we went to IPO, we were close to around 3,500 crores. I take the liberty to call this 5,600 at 6,000 crores. So in the most difficult of the 3 years, we have grown from 3,500 to 6,000 crores. So given an opportunity, we are keen to grow, we will grow. It is just a matter of prudence at the right time. So what you call in cricket, timing. Timing is very important.
Sure. No, I respect that, Kamlesh. Your judgment on that obviously is the most important one. When to be defensive and when to be on the front foot. So I respect it. Thank you, Kamlesh. Bye.
Thank you. Thank you so much. We'll be in touch. Thank you.
Thank you. The next question is from the line of Sagar Jitwani from Phillip Capital. Please go ahead.
Thank you. Sir, how many branches do we plan to add this year and next year? And maybe if you can segregate it state-wise, and what will be the OPEX related to that? Thank you.
See, currently with 100 branches, if things are okay, even for the remaining 3 quarters, we will like to take it to anywhere between 150 to 175 branches. Because we would like to penetrate deep now with sufficient experience in Maharashtra, Madhya Pradesh and Rajasthan, the way we have expanded ourselves in Gujarat. And OPEX will be based not only on the branch operation. Let me tell you that for a finance company, the branch opening does not entail much of the OPEX. It is the product line which entails OPEX, that if you are into a smaller ticket size, the OPEX will be higher. If you are into a larger ticket size, the OPEX will be higher. So depending upon the products that we have at various branches, the OPEX will be accordingly aligned. So it's difficult to give a complete number, but depending upon the branch, depending upon the product they develop, that will be the resultant OPEX.
Okay. And sir, what is the emergency credit book stands at currently, and what is the yield on that?
Which book?
ECLG. Yeah, it is 19 crores. 19 crores.
Okay. And thank you so much.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Mr. Kamlesh Gandhi, Chairman and Managing Director, for closing comments.
So thank you, everybody. And I wish all of you very good health. Please take care of yourself, the family, your colleagues, and please stay safe. and we at Mars will do the same. And let me assure you that we'll endeavor to accomplish and to work very hard on our mission of excellence to endeavor. Thank you for your support all the way, and wish you all the best. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.